I'm not greedy. I'm not out there to refinance everyone just to get on the trail book. I believe in building longer lasting relationships. I'm in it for the long term. Inflation is coming in towards the target band, and therefore there's no need to continue raising the cash rate. I'm very privileged to deal with a lot of individuals, a lot of borrowers, and they're feeling the pinch. Even if I could say to someone, look, you could borrow $700,000 on paper, they're going, yeah, but I don't want to spend more than $3,500 a month on my mortgage repayment. That's my budget. I think it's going to get worse before it gets better. And I do think that will impact the property market.
Well, welcome,
Thank
Joe
you.
Iezzi. Is that how you say it?
Yeah.
Yeah, perfect.
That's right.
Delta Wealth, our preferred financial guru.
Thank you.
Because you're not just doing mortgage broking, which that's your title and that's your industry, but you're helping our clients with a lot more than that at the moment. You're helping our team as well, setting some goals, what they need to do to position themselves in the best possible place to be able to build some wealth.
Yeah, absolutely. Thank you for that introduction. I don't think I'm a guru by any stretch of the imagination, but I think that's probably been what's I'm enjoying the most as a mortgage broker, and I put that in quotation marks, because I think when I started the business only 6 months ago, I came out and said that broking shouldn't be transactional, and I guess I didn't really know what that meant when I was saying it. I just knew what I wanted the client experience to be like.
Yes.
And I think that's starting to permeate and starting to actually take place. So that's exactly right. I encourage people to get in touch with me in the same way they would with an accountant or a financial planner. Or even a doctor. You know, you don't need to be necessarily buying or actively changing something in your life to see a mortgage broker, and especially to see myself. I'm more than happy to have conversations, look at what you've done, where you're planning to go, and as you say, kind of workshop and strategize with people. And that's been a bit of a different approach perhaps to standard broking. And yes, while I'm not qualified, I'm not a financial planner, I'm not an accountant, I can't give tax advice. I can definitely be a little bit more holistic about what you can do and how you can get there from a lending point of view, and look at hypotheticals and workshop things. And I've been loving that.
Yeah, absolutely. And I think with your background coming from Macquarie,
that's right.
you know, you've had access to the sort of people where they need that holistic sort of advice. You know, my background, I did 4.5 years in financial planning. So I know in the financial planning world, you're restricted to an approved product list where you can only recommend what's on the approved product list that the deal group have ticked and said this is appropriate for client advice. Whereas when you're not restricted by that, yes, you can't give full accredited financial advice, but you can certainly help people set some goals, and you know, you don't need a qualification to help people set goals.
It becomes a little bit more nebulous, I think. As a banker or analyst, firstly, loved Macquarie. Everyone who knows me knows that. I talk about it all the time. But you are within a box. You're working for a bank who has one policy and one way of looking at things. And what was really exciting for me to go into the world of broking, one of the reasons I did it, is because no longer was I turning people down. If there was an option anywhere in the world, I can do my best to find it. Doesn't mean I don't turn people down or I don't help them towards a yes over time and educate them, which is really important as well. But it's no longer, sorry, computer says no, we can't help you, go elsewhere. There's another bank or another lender, second tier, third tier, that can do it, and that's right for the client. It's still an option, and I think that's really exciting. Probably similar to what you're kind of saying as well.
Absolutely. And you've been able to help a lot of our clients who, you know, they may not be better off refinancing or changing their lending institution, but they've had that second opinion. They've had someone cast their eye over it and say, hey, you may not be better off going elsewhere. You may be good just to stick where you are.
Absolutely. I used the doctor analogy before. I'm not putting myself on the same playing field as a medical professional by any means, but it's that kind of, what's the word they use? Like that non-intrusive approach to medicine maybe. It's similar with me and the way I look at lending. I'm not greedy. I'm not out there to refinance everyone just to get on the trail book. I believe in building longer lasting relationships. I'm in it for the long term. And I'll be very frank and upfront with anyone. If they're on a rate that I don't think it's worth refinancing, or if they're in a situation when I don't think it's worth it, I'll tell them that. And naturally, that person will reach out to me when it is right. And I've obviously built trust by doing that. And that's really important.
Yeah.
Literally this week, someone booked me in for a consultation. They were with an existing lender coming off their fixed rate and going to reversion.
Yep.
But they were introduced to that bank by another broker. And I said, well, honestly, speak to that broker first, see what they can do. This is what your rate should be. I can tell you because this is what that bank's offering new customers.
Yes.
Have a conversation with them. If the broker and that bank can't help you, then we can look at refinancing. You can come and speak to me. But, you know, even in that situation, they loved the bank they were with. They loved the app. They loved the experience. They were gushing over it.
Yeah.
So why would I refinance them?
Yeah.
To save 0.05% of it, or, you know, on their interest rate.
Yeah.
So, yeah, that's exactly right. I don't necessarily go in and shake up everything and change it for no reason.
Yeah.
I think to expand on that as well, what I've really been enjoying is those sorts of conversations where it is open-ended. I really love people. I love numbers. I love people. It's why I chose this as a career.
Yeah.
I love spending half hour just chatting through with someone. There's no template or structure to the meetings. It's not, this is exactly how we're going to go about it.
Yeah.
Let the individual speak, tell me their story, tell me where their pain points are, tell me what they want to do, and then we just workshop it from there. And that's really enjoyable. No one conversation's the same. And that's awesome.
That's
cool.
What
makes it fun.
Yeah, I love it. Well, that's given some great intro and a great background about what we're going to talk about today. We had an email earlier in the week where you got through an article, ABC. You said that's probably like the crux of a lot of your conversations at the moment. And sort of when people say, how's the market? What are interest rates going to do? Like it's such buzzwordy things. And at the end of the day, it probably doesn't really matter that much. But let's get into it. So what do you think of the market and of the lending landscape at the moment?
Awesome. So yes, question that I get asked more than any other question. What is the market doing? I this week filmed our Delta quarterly market update basically.
Yep.
So it goes out to everyone on my distribution list just as a bit of a check-in, I suppose. And in that I talk about what's happened and also what I think will happen over the next 6 to 12 months.
Yeah.
And I, firstly, I'm not an economist. So I listen and I read, and I can talk about what's being said, but big asterisks on this, big disclaimer.
Because you're half interesting. That's why you're not an economist.
Thank you. Yeah, I won't comment on that.
Yeah.
But thank you for
economists, don't you? Yeah.
But look, so yeah, question number one, any more RBA cash rate rises on the way? The consensus is no.
Yeah.
Okay.
Good news.
I don't think that's particularly outrageous to say that. Does it mean it's not going to happen? No, there's always a chance. But at the moment, inflation is coming in towards the target band, and therefore there's no need to continue raising the cash rate.
Yeah.
So the next question everyone asks is, okay, well, no more rate rises, great. When are we going to start seeing some relief? When's the RBA going to start to lower its interest rates? Now, there's a ton of factors that impact that globally and domestically.
Yes.
I'll keep my view on it very simple. The consensus again is that we'll start to see the cash rate come down between June and December 2024, which is a large window.
Yeah.
Now, it's much more likely to be later in the year, if not towards the start of 2025, than it is to be in June, July.
Sure.
But one of the factors that I think isn't being discussed too much and was in that article I mentioned to you earlier in the week was the tax cuts that we've got coming at the start of the next financial year, stage 3 tax cuts.
Yeah.
So what are they doing? They're getting rid of the $180,000 to $200,000 tax bracket for income. And then they're softening the marginal tax rate for income earners from $45,000 to $200,000.
Yes.
From 32.5% to 30%. ANZ think that what that's going to do, it will have the equivalent impact of the cash rate being reduced by 50 basis points.
Yep.
So the genuine impact of basically consumers having more cash in their back pocket and being taxed less would be have the same effect as the mortgage rate going down 50 basis points.
Yep.
So the RBA is well aware of this. They don't want to. The last thing the RBA wants to do is literally heat up the market too quickly.
Absolutely.
It basically doesn't matter what the RBA does. Everyone seems to hate them.
Yep.
But so they are damned if they do, damned if they don't.
Yeah.
There's a beetle on the floor. Anyway, it's moving towards me. I don't like
That's
bugs.
okay.
So
That's all right. Just squash it if it gets too close.
I won't be harming anything.
If you just hear this whoosh on the podcast. It's Joe killing a beetle on the ground.
Nothing says we're in Toowoomba like there being wildlife inside the recording studio. It is a black beetle. Looks like it's coming towards me. I'm scared.
Does it have the big horn on it? The rhinoceros? It's not a rhinoceros.
Baby rhinoceros. Can you see it?
No, I can't.
It's like a grasshopper meets. Whoa. Okay. Nothing was injured. Nothing was killed.
Nothing was injured.
Of this podcast.
The wildlife enthusiasts have just stopped listening. They heard the crunch of the grasshopper.
For those who can't see, Jacob grabbed a jar and put the grasshopper in the jar, took it outside gently, and released it into the wilderness.
I just missed it and got my boot. Yeah.
I've lost my train of thought. RBA.
This is what podcasts are for. Where you have these random interruptions.
I do get distracted easily.
Yeah.
So
RBA,
the RBA doesn't want to soften the cash rate too quickly, especially if there's tandem tax cuts on the way, and overheat the market again. It would create the problem it's trying to solve. So that's basically the point there. And for that reason, the RBA might be a little bit cautious, a little bit tentative around reducing the rates in Australia. This is a domestic point.
Yes.
For that reason, there's plenty of other factors. Again, I'm not an expert. There's plenty of other factors that are playing a part in it. But by all means, it seems like the impact of all of these cash rate rises is starting to be felt. In fact, I was listening to a podcast on the drive here this morning where a gentleman who, I won't say who he was, but he speculates that the delinquency rate on mortgages will increase to 12 to 13% over the next year versus what's been an all-time low in around the 1% range over the last
that's a humongous jump.
Yeah, it's significant.
So what was the thesis behind that?
Well, basically, cash flow.
Yeah.
So mortgages, especially in like New South Wales, for example, jumping from $2,500 a month to $5,000 a month. Pay hasn't kept up with that.
Yeah.
It's a very simple sort of maths.
Yes.
Distressed sales, asset sales, people not being able to meet their repayments anymore and going, or being close to it and going, you know what, this is all too stressful, I'm just going to sell.
Yeah, absolutely.
So that's the nuts and bolts of his theory there.
Okay, so we've talked about the tax cuts coming in, them having a 50 basis points or 0.5% impact on overall affordability and the equivalent of it. Yeah.
Sure.
Okay. So that's going to lead to potentially end of 2024, early 2025 RBA cash rate cuts.
Yep.
Do you think that the recent increases over the last 2 years, say, since we've had such low rates, jump to, I don't think they're super high rates. They're probably what they should be in a healthy economy.
Yeah.
Do you think they've hit people harder than they have historically?
I don't know whether they've hit people harder than they have historically, but they certainly have hit people extremely hard. I think one of the reasons, I think the last few years has been a super fascinating case study globally, and again in Australia specifically, and even further, even more specifically, Southeast Queensland. So the first point is that, why do we raise the cash rate? To control consumer behaviour.
Yeah.
To curb inflation.
Yes.
Why didn't it work as quickly as it probably should have? Number one, a lot of consumers had a lot of savings.
Yes.
I'm going to get the statistic wrong. Big asterisk on top of this one. But I believe I heard somewhere from someone, I think it was at an REIQ event, that the average contribution, so basically the way it worked was the average contribution to offsets has gone backwards from, I think the number was 20% to 2%.
Wow.
Something like that. So basically...
It's a large discrepancy.
So pre-COVID, lots and lots of borrowers were actively contributing into their offset account, which is basically an indicator of discretionary savings or cash you don't need to spend.
Yes.
What do you do with it? Chuck it in the offset account.
Yep.
So that was happening. It's happening a lot less. Let's just say that. I'm going to get those numbers wrong.
No, that's good.
And I don't know how many people listen
the principle
to this, but I'll probably
is,
get grilled for it.
Yeah, the principle's there.
Overarchingly, the point is people are contributing to their offset account significantly less than they were 2 years ago.
Yeah.
What else happened 2 years ago? Well, you couldn't travel interstate, you couldn't travel overseas. People saved up.
Yeah.
They saved cash.
Absolutely.
Hence why the contribution to offsets was so significant.
Yeah.
Second factor, a lot of people in Australia are on fixed rates. Again, I'm going to get the statistic wrong, but in the US, the amount of borrowers who are on fixed is significantly lower than in Australia.
Yeah.
Significantly. And so borrowers in the US, and therefore economic and consumer behavior is much more intrinsically, it reacts much quicker
Yes.
to an increase in the cash rate.
Yep.
Because cash rate goes up, you're on variable. Okay, my repayments have gone from X amount per week to Y amount per week.
Yep.
That's, I know it can no longer go out for that, whatever it might be that I was going to do on the weekends or whatnot.
Yep. I need to save this money because I don't have it anymore.
No,
yeah.
that's right.
That's right. Yep.
In Australia, so much of the mortgage market was fixed that those individual and because of brokers, brokers did a great job fixing a lot of individuals. But yeah, the rate goes up, doesn't impact you.
Yeah.
Right. So you continue to spend, but the RBA is raising the rates to stop you spending to curb inflation.
Yeah.
So the fixed side of things and the amount of savings that people have as well. So because of those two factors and a few other factors as well, Australians reacted and responded to RBA cash rate rises slower than other global economies.
Yep.
And so
that makes a lot of sense.
Really seeing the hangover kind of now and probably over the next 12 months, hence why that individual I mentioned before is talking about 13% delinquencies and arrears hitting the borrower market in the next 12 months. So there is certainly a lag effect and that's been seen. I think we are starting to see the impacts of that. And I think just anecdotally speaking, I mean, personally, I'm very privileged to deal with a lot of individuals, a lot of borrowers, and they're feeling the pinch.
Yeah.
They absolutely are. People are aware of their spending much more than they probably were 2 years
Yeah.
ago. People are cautious. People are concerned. A question I get asked almost immediately now when I'm speaking to someone is, what are my repayments going to be?
Yeah.
That's how people are quantifying things.
People just looking at their inflows and outflows.
Yeah, they're not
and it's
so
the
caught
biggest
up.
items as well.
Absolutely.
Like when you look at your income and expenses, you should be trying to either reduce or maximize your biggest numbers on those spreadsheets, not your smallest ones. Yeah,
absolutely. So less questions about how much can I borrow, more questions about, well, I do care about how much I can borrow, but how much is it going to cost me?
Yeah.
And to be fair, like clients are the ones driving that conversation. I always bring it back to budgets and, just so you know, but I don't need to prompt it anymore. They're all saying to me, like they're the ones bringing it up. How much is that going to cost?
It's an interesting behavior change.
That's driving everything.
Yeah.
So even if I could say to someone, look, you could borrow $700,000 on paper, they're going, yeah, but I don't want to spend more than $3,500 a month on my mortgage repayment.
Yep.
That's my budget.
Interesting.
So I don't even remember what your question was and don't know if I answered it. Are we feeling it more than before?
Yeah.
I don't know if we're feeling it more than historically.
Okay.
And I can't really comment. I wasn't a mortgage broker during the GFC, for example.
Yeah.
But but individuals are certainly starting to feel it. And I think it's going to get worse before it gets better.
Yep.
And I do think that will impact the property market, but I'm keen to get your thoughts on that too.
Interesting. Yeah, I think we're having a lot of those conversations from a sales side, from a property management side, about, what are my options? When it comes up to lease renewal time, it's not an automatic approval on the lease renewal.
Yeah.
It's potentially a pushback for a slightly higher rent than what we've recommended. And for the record, we always recommend market rate when we recommend to clients for their renewal.
Yep.
And then it's like, okay, well, if you want a little bit more, we're going to have to do a trade-off. We're going to have to put an aircon in. We might have to put a dishwasher in. We might have to spruce something up a little bit to justify that. And property managers are always made out to be the bad guys in that situation, but that's another story completely. Sure. I think that we're having the conversations, or I know that we're having the conversations where people are going to put their property on the market, but they've left it too late in their affordability cycle.
Yeah.
They've gone, I can't afford this property anymore. I need to sell. We go in and say, okay, well, you need to do A, B, and C.
Yeah.
And they go,
Can't afford it.
nope, not happening.
Yeah.
And we go, well, you're just going to get hammered on building and pest inspections.
It's a slippery slope, isn't it?
Exactly. And the amount of pushback and renegotiation under building and pest inspection, in our office, we have never seen the level that we have in the last 6 to 12 months.
Yeah.
People coming back asking for $10,000, $15,000, $20,000 price reductions because it's not to a brand new standard.
Yeah.
Like, I think there used to be, or when the market was more reasonable, let's say in terms of price, there was an understanding that I'm not buying a brand new home. I'm buying something that was built in the 80s. There's going to be cracks in the plaster and the cornice. There's going to be movement.
Yeah.
You're building on black soil in Toowoomba. That sort of stuff is bound to happen. The fences might have moved.
Yep.
There might be, there might be a rust spot on the flexi hose underneath the sink or the basin. Now they're coming back and they're going, every single defect that's written on the building and pest report, I want a price reduction for this, or I want it rectified. And people go, sorry, did they not inspect the property? Were they not aware of this? And it's a real challenge, and it's a real challenge for our sales team because they have worked to get an excellent price for their client.
Yeah.
And then the buyers come back and go, bang, 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 I want a price reduction on these things. And then they go, oh, well. And at that point, it's really tricky. Do we step in as an agent and go and negotiate for them? Or do we let the solicitors do their thing and the client, at the end of the day, we've done our job, we've secured a sale, we've secured a buy. It's really tricky.
It's two sides of the same coin. It's a little bit ironic because you just mentioned that the vendors aren't really willing to fork out any more because they're cash strapped to make any more improvements or rectify any defects, but the buyer doesn't want them either.
That's right.
And is trying to get a price reduction. So you're kind of damned if you do, damned if you don't. But that's tough.
It's really tricky.
Tough problem.
And I think it comes back to that affordability piece, what people can and can't afford. Maybe they're leaving it a bit too late. Maybe they're not aware of how much their repayments have jumped. I know my sister, for example, she didn't realize how much her mortgage had changed until she got the paper statement from the bank at the end of the quarter. And it made a lot of sense, but they weren't necessarily, it wasn't in their field of vision. Absolutely. It wasn't in their scope. So that's really interesting. What are the best steps for people who are feeling the pinch, or they want to be more aware of it, or they just don't know? What are the steps that they can take?
Yeah, it's alarming how often I ask what interest rate a new client's on if they're looking to potentially refinance, and they've come to me for some advice, and they just say, I don't know.
Yep.
And in fact, it's such a common behavior where we bury our head in the sand. So that's what they say. Oh, I haven't checked. It's frightening every time I look at it. I prefer not to.
Yep.
Not the right approach, because that's when you get into those situations you're talking about when it's too little too late.
Yeah.
That's what we're trying to avoid. So there isn't a blanket cure here. There's no, I'd love to sit here and pretend that seeing a mortgage broker 3 months before or 3 months earlier will solve all your problems. It won't necessarily. I think you need to educate yourself though. I think having some education around the parameters of what's happening can help you make decisions behaviorally that can assist and potentially soften the blow. But it won't prevent the problem from happening altogether.
No.
We're in a very difficult economic situation where people's mortgage repayments are going up. Well, they at least have been for the last 2 years. That's not fun.
So we've spoken about potentially some of the doom and gloom side of it. Spoken about some strategies that people can employ when they're in that position that they don't really want to find themselves in. What are the opportunities in the market? I know we've spoken about rent vesting before. We've spoken about interest only. You touched on some of those options there. What opportunities lie for people who are in a favourable position or are really wanting to kick their wealth goals in the guts?
Again, on that podcast I was listening to this morning, I heard that those with money are waiting on the sidelines. Those with cash are waiting on the sidelines. Because we're in a really we're probably at a tipping point, I suppose, in terms of where the rate cycle is at the moment. And we know that the cash rate has a inverse relationship generally with property prices in Australia. So as the cash rate goes up, property prices should go down. It hasn't really happened too much in Queensland anyway recently. And there's a number of factors for that to be the case, but that's the idea. Conversely, when the rate comes down, money becomes cheaper and more affordable, your borrowing capacity goes up. All of a sudden, those individuals who I'm telling can only borrow 600,000 and therefore can only purchase a home for 800 or 700 or whatever it may be, depending on their deposit. They can now buy a property for $900 to $1 million. So more demand on that type of property. I guess, the other factor that we're not really sure of is, how many distressed asset sales are we going to see over the next 12 to 18 months as well, and will that soften the property market?
And there could be some really great opportunities to be had. Absolutely. People who just need to get out. If you can go in there with favourable terms, a pre-approval potentially. Happy days.
Absolutely. So that's something that is certainly an opportunity. If prices start to come down, two, if rates come down, then your borrowing capacity goes up, but you're competing with others who are doing the same thing. Those borrowers who I speak to who are in that really favourable position, who are high income earners, who have good liquidity as well, they're poised and ready to go, and they're pretty much waiting in the rafters for those opportunities. because they're quite happy, especially when it comes to investment properties, they're quite happy to pay 6.5%, 7% for their loan, buy a property now, hope or at least expect that the cash rate will come down in 12 to 18 months. And as it starts to come down, they should benefit from some capital growth in that investment because that property will go up in value. So that's probably fundamentally where the opportunity is. But again, like I'm always cautious around these conversations, and aware that I'm on a podcast right now, which I've probably forgotten a little bit throughout this morning. But like that's just, it's an academic point of view. It's not like, how many economists got things wrong pre-COVID?
Oh,
like,
how many economists get things wrong daily, all the time?
So
like,
there's a bunch of caveats in everything I'm saying, but I think that's probably where one opportunity would be. I think you touched on rent vesting. That is something I'm talking about every day.
Yes.
Especially even in the first property buyer, or say first property buyer, not first home buyer, with intent, because when individuals come to me looking to potentially buy their first home, we do talk about the idea of rent vesting. So it does work. Very recently, I literally had someone who was looking to buy their first home and decided to buy an investment property instead. And I've just done it this week with another couple who were in a similar position. Why? Because their budget goes up. They can get into a property that they really want and figure the rest out kind of later. So this particular couple were living in the male applicant's family home, parents' home, not in a rush to move. I explained to them that their borrowing capacity on an owner-occupied property was around $600,000, and on an investment property in that particular area was around $850,000.
Yeah, wow.
So why not stay at home, increase your budget by $250,000 thereabouts, and get into a property that you really want now. When I say get into, own. Then move into a property that you probably don't necessarily want just into the property market.
That's right. And it's time in the market, not timing the market as well.
Absolutely. So I think that's popular. Why does rent vesting work? One, your income goes up. Because you've got rental income coming through. Especially if you're living at home. There's this thing called notional rent. So a lot of lenders, even if you're living at home, will apply this notional rent amount as part of your budget, as part of your expenses. You're not paying board or anything to your parents. But still, generally speaking, as long as the property that you've purchased is returning more income than the rent you're paying, rent vesting's great because your net income has gone up.
Absolutely.
So your borrowing capacity has gone up. The other reason, of course, is the debt is tax deductible. So you get the benefit of negative gearing, and that also helps with your borrowing capacity. So that's an opportunity. It's something to consider. It doesn't suit everyone, but I think it's worth considering. And I think well, I don't know if it's an opportunity. It's always existed, but I think it's becoming more and more popular. I think why my speculation is that. Especially in that first home buyer region, so many people's friends have bought properties in that $1 million space 2 years ago. Or maybe, and I'm talking about Brisbane at the moment, but or that $800,000 space. Or their properties are worth $1 million or $800,000 now. And so they're comparing themselves. They're going, well, those guys bought that property for that much, or their property is worth that much. I want to do the same. Joe's telling me I can only borrow $600,000, which is not where I want to live, not how I want to live. It's either an apartment, I want a house, or it's a house out in the sticks and I want to be closer to the city. Well, I still want that house. And so therefore, one way to get it is to rent vest. And another version of rent vesting as well is those who rent where they want to live and buy where they don't. So that's different. I'm not really talking about that. But it's another iteration of the same thing.
Love that. Before we go, because I'm conscious of time, and people's attention spans.
So there'll be a lot of editing.
Hopefully
on this video.
people have made it this far. But auctions and bidding at auctions, people don't understand that on the fall of the hammer, that it's an unconditional contract.
Correct.
But people think that because they've got a pre-approval letter in their back pocket,
I'm glad you mentioned
they can go and stick their paddle up at an auction and buy. But there's a very ugly side to if they can't get that finance, or if their situation's changed, or if the bank's policies have changed, or the interest rate has moved. Talk us through that and the risks, but also what you really need to consider before bidding at auction under finance.
I'm probably a more conservative finance broker than others. Okay. So I really am cautious, and I spend a lot of time educating individuals in this situation looking to bid at auction around the risks. Doesn't mean I tell them not to do it. I just tell them what can happen, which is what we're doing now.
Sure.
So, okay, firstly, I want to categorize or talk more about the words pre-approval. Is that one word? What do you call that?
Hyphenated conjunction? I don't know.
Word?
Yeah.
Anyway.
Leave that for the grammar police.
Okay, fantastic. I'm looking forward to it. Pre-approval gets thrown around loosely. Different lenders use the same term, but it means different things. What do I mean by that? Lender A, I submit an application. A computer looks at the data points. It can see that I've submitted A, B, and C, and it says, congratulations, you have pre-approval. And that's pre-approval.
Right.
Then there's this thing called conditional approval, where a credit assessor, a human being, has then picked up the file, looked at it, and said, hey, subject to these conditions being satisfied, we're good to give you 700 grand. Okay, on this rate, these would be your repayments.
Yeah.
That's conditional. And then there's the thing called unconditional approval. And that is, you found the property, we're comfortable with the property, comfortable with what it's worth, we've seen a contract of sale, we've seen a valuation, we've assessed the risk associated with the property, we believe it's worth this much.
Yeah.
And you've got building insurance or property insurance as well.
Yeah.
It's yours, you're good to go. You've got unconditional approval.
Yeah.
So that word doesn't line up with unconditional bidding.
Yes, that's right.
As you can imagine.
Yes.
So what are the risks? The risks are, so let's say, forget the first pre-approval thing I talked about. I would be horrified to let someone go to auction with that first pre-approval that I talked about, which is computer generated, hasn't properly assessed the file. I wouldn't be sending any of my clients to an auction with that type of pre-approval. I always want an individual to pick up the file. So I say to the bank, and some banks don't do pre-approvals. Let's make that clear.
Right.
Or credit endorsed pre-approvals.
Yep.
But if someone, especially a first home buyer who's nervous enough as it is going to an auction, I will be taking them to a lender where a human being looks at the file, speaks to me and talks through the file and says, this is a conditional approval letter. So that's a little bit of risk mitigation.
Sure.
But it's still not risk-free. Why? Because you get to auction and the one thing that the lender doesn't know and what you don't know is, well, what property you're buying and what it's worth. And if it's a rental property, then if it's an investment property, there's another thing to consider, which is the rental income.
Yeah.
So the risks are you go onto the hammer, you purchase the property, the bank said you can borrow $700,000, you've got the deposit there, and you do indeed go to contract unconditionally on a property that's within the parameters of borrowing. So, it's not overextending you. Let's just assume that with a 700 grand loan, you had a very good deposit and you could comfortably pay for an $850,000 property plus stamps and any other transaction.
But you haven't got excited at the auction and bid up to $1 million.
No, exactly. So it's within the parameters of your lending and borrowing power and your buying power. And that's what I do with individuals as well. Side note, really important to keep in mind, a pre-approval or a conditional approval doesn't tell you how much you can spend on the property. Okay? It tells you how much you can borrow.
Yes.
So that will be a $600,000 loan.
Yeah.
80% loan to value ratio.
Yes.
If you find a property where the purchase price, there's actually in those letters, there's what's called a minimum purchase price, not a maximum, a minimum purchase price. Because if your purchase price goes less than a certain amount, your loan to value ratio with that loan doesn't move, exceeds 80%. Then you're in lender's mortgage insurance territory. Yeah. So you'll get generally speaking, that's fine. What would happen is you'd lower the loan as well.
Yes.
At settlement, when you're turning it into an unconditional approval, that's what we'd do. So it's not the end of the world. Yes, you can of course buy something less, but the loan will be less too to keep that ratio the same. But if you want to go higher, absolutely you can, but the bank ain't giving you that money.
Yep.
You got to find it. So that happens frequently. People go, oh, so what if I'm at an auction and I'm good to go for 900, but it goes up to 901,000. Can I bid or is it over?
Yeah.
No, you've got a loan for 700 grand. If your grandma's going to give you $1,000 to complete purchase, absolutely go for it. But just keep that in mind and we strategize and make sure we know the parameters around all that. And, so
cool.
Sorry, I'm digressing. But the main risk fundamentally is that the asset isn't yet valued. Yeah. I'm hearing a lot that from your sales agents that valuations are coming in under contract price. Yep. Haven't seen a great deal of that in my time in Brizzy, but I know it happens. So that's an obvious risk. If a bank says you've got conditional approval for a $700,000 loan and an 80% loan to value ratio, and you go under the hammer and the valuation comes in, you paid 900 for it, and the valuation comes in at 850, you're not going to get an 80% loan against 900, you're going to get an 80% loan against 850. Yeah. Okay? Which means your loan amount will go down. Your loan isn't what you thought you had. Therefore, you need potentially more cash. What you do. It's a 900 grand purchase. Right? you got to come up with that cash.
Yeah, there's a
That's
shortfall.
a risk. There's a
Yeah,
shortfall.
and
Exactly right.
that's a real risk.
That's
and
a
that's
real risk.
money that we've already discussed people don't necessarily have sitting around, lying around,
Absolutely.
collecting dust.
Absolutely.
Yeah.
So that's one. The valuation, the contract of sale, that point. And I think when it comes to this idea of unconditional, let me make it super clear. The only thing that exists that is unconditional is cash.
Yep.
Or like redraw available on an existing
Yes.
debt. So you've got a loan, you owe $0, you've got $1 million redraw available. That's unconditional. Or $1 million in your back pocket. That's unconditional. That's you are able to buy that unconditionally.
Yeah.
Everything else, if there's a bank involved, it's not unconditional. It is conditional on the property. So there is a risk there.
Yeah.
Again, as I said, I'm cautious, I'm conservative.
Yeah. Mate, loud and clear received. Yeah,
Yeah, it's
I get
on
it.
the side of
Yeah,
caution.
yeah. And I think that's a great warning, but also a great message to our listeners as well. You know, because they see stuff on the block auctions, they see stuff on TV, they hear stories from their friends. It's easy to go to an auction in New Farm and line up with 1,000 other people and see bidders galore. But you don't know their personal circumstances.
That's exactly right.
You know, maybe they are acting outside of what they can or should
Possibly,
be doing.
or maybe they've got a really good broker who has talked to them about the parameters of what they can do, and they have a game plan.
Yeah.
And they know.
Yep.
That's all. That's all it is.
Absolutely.
I'm not saying don't go to auction. I'm just saying know the risks and mitigate against them.
Yep.
Can I make one final point on that?
100%.
Before we end up in this one. So
Go for it.
purchasing an investment property. So this rent vesting example we're talking
Yes.
about. Your borrowing capacity is impacted by the rental income. So there's a further risk to going unconditional or to bidding at auction on an investment property when you've got pre-approval or conditional approval.
Yeah.
And that is that I've lodged an application on your behalf to the bank saying that this applicant is going to buy a $1 million investment property, returning how much per week? Well, if I put in that application, what is a reasonable amount of rental income per week?
Yeah.
$1 million property, let's call it a $1.2 million property in Ashgrove, $1,100 per week would be pretty reasonable.
Sure.
If I submit it like that and you purchase the property, you're successful at auction, a valuation occurs or a rental appraisal occurs, and it says that that property is only receiving $800 to $900 a week, the bank will use that. And what's that do? It impacts your borrowing capacity. And now all of a sudden, you're not able to borrow the 800 we talked about. You're only able to borrow 700 and you're in that position again. So again, doesn't mean you can't buy rental properties at auction. I just educate the clients about, hey, I'm actually going to submit this application on $700 per week.
Yeah.
I know it will get $1,100 every day of the week, but I want a bit of a buffer there.
Yeah.
This is your borrowing capacity is fine. Like you're not in a situation where you really wanted 1.5 mil and you need that $1,100 per week. So that's not a risk.
Yes.
Comfortable with that.
Yep.
But the benefit is you're not going to get caught out.
Happy days.
At auction day. So that's something else to just think about. Again, education and strategy, not a blanket. Don't do auctions. Don't involve yourself in that. Just know the risks and have a good kind of plan of attack.
Lovely. Thanks, mate. I really appreciate your time. Really appreciate your insights.
All good.
If people want to get in touch with you, how do they best do that?
Yeah. Well, good question. We've got a website, so deltawealth.com.au. Instagram, delta.wealth, I think is the Instagram handle. Of course, get in touch with Hot Property. I'm here in Toowoomba at least once a week.
I love that people can book their consultation with you on the Calendly link.
Yep.
Bang, bang, bang. Booking time. You jump on.
Love it. I do after hours, before hours, weekends. Love it. Any time that suits people, they can book me in. I love the opportunity to chat.
Awesome. Thanks, mate.
Thanks, Jacob. Appreciate it.